Hi, my name is Chrislyn Aiko and today I'm going to tackle about stock financing. So do you have any idea what is stock financing? Stock financing refers to the process of selling stock in order to raise money para sa company's long-term financing needs. Also, stock financing's main goal is to raise equity capital. So selling stock shares is how both big and small businesses accomplish this. So next, I will proceed to the advantage of stock financing. So stock financing kay mo offer siya og distinct advantage over sa bond financing para sa long-term financing. Mo eliminates pud siya sa needs para sa periodic redemption, no maturity periods, and di siya mo-require og collaterals, and making it more flexible option for companies seeking financing. So the next topic that I will be tackle about is capital stock, dividends, and retained earnings. So capital stock represents the interest of a corporation's owner divided into shares representing a portion of total ownership interest. Next is the dividends. Dividends may be distributed to stockholders while retained earnings account for capital financing requirements. The nominal capital stock in a firm's balance sheet is nominal, while retained earnings is may increase ang actual and market value sa company shares of stock.
Hi everyone, I am Jerry Isler and I will be discussing about the classes of corporate stocks. Common stocks is a class of stock issued by all corporations and which represents the real equity capital. It has a residual claim to earnings and asset and which carries the risk of business success or failure. So it is a type of tradable asset or security that equates to ownership in a company. So if you own common stocks in a company, you have the rights to things like corporate policies and board of director decisions. So common stock is just one type of stock traded on public exchange. If you have common stock, you're a shareholder or a partial owner. So for the investors who purchase the common stocks, it represents an investment in a company and is therefore an asset for the investors. However, it is not a liability for the company as it does not represent an obligation to pay anything to the investors. So we have here classified common stocks. So this stock is a type of common stock that has special privilege such as enhanced voting rights or dividend rights. Several types of classified stocks are Class A or Class B stocks. So Class A shares are shares held by founder, key investors, and management teams. Each Class A shares comes with 10 votes per share, ensuring that these shareholders have significant control over the company's decision-making process. So Class B shares. So Class B shares are shares issued to the general public through an initial public offering or IPO. Each of the Class B shares has one vote per share, allowing public shareholders to participate in the company's ownership but without providing them the same level of control as Class A shareholders. So common stocks can be categorized based on issuer and investors' needs. Class A stocks may offer advantage such as dividend preference and priority in liquidation, but often comes with restriction like limited voting rights. In some cases, Class A stocks can convert to Class B at the attractive price upon successful corporate expansion. Class B shares, however, typically lack special preference and are more straightforward common stocks. We also have here preferred shares. So preferred shares are issued to the selected groups of investors who are willing to provide additional capital for the company's growth, and they have no voting rights, but they receive a fixed dividend of $1 per shares, and before any dividend are paid to Class A or Class B shareholders. So preferred shareholders have priority in receiving assets if the company is liquidated. So the next one is deferred stock. Deferred stock is a method of stock payment to directors and executive of a company and these are deposited into the locked account. The value of these shares fluctuated with the market and cannot be accessed by the beneficiary for the purpose of liquidation until they are no longer employees of the company. So the other term of deferred is postponed, postponed, adjourned, or delayed. So deferred stock is a special type of stock that gives its holder the right to receive dividends and asset only after common stockholders have been paid in case the company dissolves. So these stocks is usually given as a bonus to founders, promoters, or managers for their role in starting the corporation. So the key point is that these stake or stockholders agrees not to contribute assets and their returns or not contribute their assets and in their returns it depends on the business success. And one main features is that dividends are delayed until after one stock after other stock classes received their dividends. Trust certificates. So this document is issued by a limited trust of a corporation established to give a temporary voting controls of a corporation to one or a few individuals. So it is issued to a stockholder in exchange for his or her common stocks and represent all of the normal rights of a shareholders. So this allow one or a small number of individuals known as voting trustees to gain control and make decisions regarding the corporation without interference. So voting trust certificates are given to a trustees of a corporation, granting them voting power for a specified period to ensure control remains in a specific hands. One is guaranteed stocks. So these stocks typically refers to a stock that is considered low risk, often associated with stable companies or established industries. It implies a level of confidence in the stock's performance, suggesting a lower likelihood significant of fluctuation or losses. Investors may view guaranteed stocks as more secure investment. So guaranteed stocks refers to a stock of a corporation wherein the payment of the dividend is guaranteed by another corporation. So guarantees may arise when a corporation purchases or leases the product or the property of another. A holding company may also guarantee the stock issues of one of its smaller subsidiaries to make a issue more attractive in the market. The next one is debenture stocks. Although called stocks, is more like a loan than traditional stocks. It is a form of fixed interest security issued by companies for long-term loans, with redemption typically occurring 10 to 40 years from the issued date. So there are two types of debenture stocks. The first one is fixed debentures, these are secured by specific assets. And the next one is floating debentures, generally secured by a charge on the company's asset. So unlike shares, debenture holders receive fixed interest whether the company, is not profitable or not. So in case of liquidation, debenture holders have priority over shareholders in claiming company's asset. So some debentures, like convertible debentures, can be converted into common shares at a predetermined price at a future date.
So, hello everyone. My name is Sheen Tubin. I am here now to discuss advantages of common stock financing. First, it does not entail fixed charges, unlike debts that carry the burden of interest payments. Common stock pays dividends only when profits are realized by the company. So, common stock doesn't come with fixed charges, unlike debts that require regular interest payments. Dividends from common stock are only paid when the company makes profit. So it's like having a friend who only expects a treat when you have a good day at work. Next, the second is there is no fixed maturity date attached to common stock financing. As a result, the company is not obliged to set aside a specific amount to pay back common stock on a specific date. So, common stock doesn't have maturity date. This means that the company doesn't have to worry about repaying the value of the stocks at a specific time. It's like having a library book with no due date. Number three is the firm's credit standing is enhanced with the sale of common stock. This is so because whatever losses are incurred by the company are absorbed first by the common stock. The creditors will only be affected when losses are bigger than the common stock. So, selling common stock can boost a company's credit standing. This is because any losses the company makes are first absorbed by the common stock. Creditors are only feel the pinch when losses exceed the value of the common stock. So fourth, there are times when common stock is easier to sell than debts. This happens when stocks provide higher returns than preferred stocks or debts. So sometimes common stocks is easier to sell than debts. This is especially true when stocks offer higher returns than preferred stocks or debts. It's like selling hotcakes at a fair, so they're more attractive when they're the tastier option around. Let's move to disadvantages of common stock financing. First, it gives new shareholders the right to share control of the corporation. Issuing common stock allows new shareholders to have say in the corporation decisions. So it's like inviting new members in the club so they get to vote and say and have a say in how the club is run. Second, it has a dilutive effect on the corporation's earnings per share and price per share. Issuing more common stock can dilute the corporation's earnings per share and price per share. Imagine a pizza being the company's earnings. If you have to share it with shareholders, each of them gets a smaller slice or let's lower earnings per share. Third, it is more expensive to underwrite the distribute common stock than preferred stock or debt. Issuing common stock can be more expensive than issuing preferred stock or debt. This is because of the cost associated with underwriting and stock, distributing the stock. So it's like planning a big party. So the more guests you invite, the more it costs. Fourth, there's a risk that investor might see the issuance of common stocks as a negative sign. They might think the company is desperate for cash, um, which could cause the stock price to fall. It's like if a popular restaurant suddenly started offering big discounts, people might start wondering if the food quality has gone down.
Hi everyone, my name is Excelford Cosi and I'm here to discuss about preferred stock and its provision. But first, what is preferred stock? Preferred stock is a component of share capital that may have any combination of features not possessed by common stock. And preferred stock is a piece of equity in a business. So preferred stock doesn't come with the right to vote but does come with the right to receive dividends prior to common stockholders and a higher priority in getting paid back if a company goes bankrupt. So kaning preferred stock mao ni siya tawag sa pundo nimo sa isa ka company if mo invest ka adto. Like for example, mo invest ka sa company nga Jollibee. So matawag ka nga isa ka owner sa Jollibee kanya hatag man ka kan dito sa Jollibee capital. So matawag ka nga kanang stockholders. So if ang company nga Jollibee ma bankrupt, so nakay higher priority nga ibalik ang atong kwarta nga imong gihatag dito sa company nga Jollibee nga kanang ikaw nga stockholders dili if preferred stockholders ka dili ka ka vote sa other about sa related sa governance kay you have doesn't right to vote man if you are preferred stockholders. Otherwise sa common stockholders pwede sila makavote. So ang common stockholders kay lain na siya sa preferred stockholders. So ang advantage sa preferred stockholders is siya mo'y unang makadawat sa dividend kaysa sa common stockholders. And also makareceive din sa asset, siya mo'y unang makareceive sa asset kaysa sa common stockholders if ang company if mabankrupt. So mo na ang preferred stock. Now we are going to tackle the 7 provisions of preferred stock. So kaning provisions of preferred stock nan siya 7 ka provisions, which are the claim to dividends, voting rights, subscription rights, callability, convertibility, participation, and classes. So first, we have the claim to dividend. So the claim to dividends is a dividend is the distribution of corporate earnings to eligible shareholders. So ang kaning claim to dividend is mo siya kanang money or amount nga na-earn sa company sa nga ihatag dito sa mga eligible shareholders. So ang kaning claim to dividend is ma-classified din siya into two, which are the cumulative and non-cumulative. So ang cumulative is a type of preferred stock with provisions that stipulates that if in any dividend payment have been missed in the past, the dividend owed must be paid out to cumulative preferred shareholders first. So ang kaning cumulative is ang mga years gani, mga past years gani nga wala na bayaran nga dividend kay tungod kay gamay ray na earn nga profit, ang karon nga year nga naka-earn sila dako og nga profit is ila tong bayaran tong past nga year. So ang preferred shareholders may dapat first nga mabayaran sa dividend. Ang next is ang non-cumulative. So ang non-cumulative is a type of preferred stock that does not entitle investors to reap any missed dividends. And also, if ang company does not pay dividends in any given year, the preferred stockholders have no rights to unpaid dividends. It means that there are no dividends in arrears. They are never going to be paid. So kanang if ang company gani nga dili makabayad sa mga past nga years nga tingbayad sa dividend is ang preferred stockholders kay wala sila rights nga i-unpaid tong mga dividends, mga past dividends. So if ang dividends nga gi-declared or paid in any given year, mawagtang na siya, they are lost forever. Mawagtang na dyan na siya forever. So ang next sa atong provisions of preferred stock is ang voting rights. So ang voting rights in general, ang preferred stockholders dili gina siya ka vote, dili gina siya ka vote, dili pare sa kanang common stockholders nga they have rights to vote. Ang preferred stockholders, they have no rights to vote. So if ang stockholders is ganahan mo vote, these are the following iyang buhaton. First is if the corporation proposes to issue a debt security or a long-term nature or additional preferred stock, ang stockholder, ang preferred stockholders is mag-issue siya og a debt og security para sa long-term nature or magpa-additional siya og magpa-additional siya og stock. And also if ang corporation proposes to issue miss dividend or fail to pay a specified number of accumulated dividends, the preferred stockholders can participate in the actual elections of the director. So ang company is makamiss gani og hatag sa dividend or maka-fail og bayad sa specified number nga accumulated adto sa kanang sa mga stockholders. Ang katong preferred stockholders is ang pwede siya makaparticipate sa actual nga election sa mga borders. So mo na ang mga preferred stockholders sa dili pwede maka-vote sa mga about nang sa mga governance. Ang common stock ray mga ang common stockholders ray naay rights nga mo vote. So next is ang subscription rights. So in case of additional issues of stock, ang uban nga preferred stockholders kay naay right nga mo subscribe sa other nga mga panghitabo. So ang uban ani is walay karapatan nga mo subscribe. So ang tawag ani nga kanang right to subscribe is gitawag ni siya nga preemptive right. So ang preemptive right is preemptive rights are give existing shareholders the right to purchase additional shares before those shares are issued to other investors or buyers. So ang kaning preemptive right is maghatag ni siya og ang right didto sa mga shareholders nga mo purchase og another or additional shares sa mga niagi nga mga shares adto sa bisag asa nga investors or buyers. So in such cases, early investors will be given an opportunity to invest in any new equity financing rounds at the same terms and conditions as outside investors. So ang mga early investors kay tagaan na sila opportunity nga mo invest sa another nga equity financing rounds nga maor gyapon ang terms and conditions sa bisag asa nga sa outside nga investors. So next sa atong provisions of preferred stock is ang callability. So ang kaning callability is maclassified ni siya into two, which are the callable and non-callable. So ang callable is a type of preferred stock that the issuer has the right to call or redeem. So ang kaning issuer aning sa callability is nani siya right, nani siya karapatan nga mo redeem sa mga gipang set nga mga price after sa defined nga date. So nani siya right nga mo call or mo redeem. Ang non-callable naman is the issuer cannot buy back the preferred shares at a specified price. So kabaliktaran ra siya. So ang callable is naay right nga mo redeem or mo call. Ang non-callable naman is dili siya pwede mo buy og balik ang issuer sa preferred nga shares. So next is ang convertibility. Convertibility is some preferred stock may also have features of convertibility. They can be converted into common shares with a certain period after the issuance of the preferred stock. So kaning convertibility is mo ni siya pamaagi nga kanang is just another way ba nga ma-convert ang kuan into preferred stock. So ang example ani is a preferred stock with a par value of 100 pesos per instance may be converted into 5 shares of common stock. So the market of common stock is 20 pesos or higher. Ang convertibility is just another way of classifying preferred stock. So ang 100 peso nga preferred ang value nga preferred stock is ma-convert ni siya into 5 shares which are tag 20 pesos ang value. So 20 times 5 is 100. So ang kaning convertibility is maklasify ni siya sa duha, which are the convertible and non-convertible. So ang convertible is preferred shares give their holders the option of convertibility into a set amount of common stock shares in the future. So sabot ra kayo nga ang kaning convertible is tagaan ni sila og kanang option nga ma-convert ang ilang amount nga shares sa future. So ang kanin namang non-convertible is a preferred stock does not give its holder the rights to convert the preferred share. So mao ra gyapon kabaliktaran ra ba nga ang kaning non-convertible is dili tagaan og rights nga ma-convert ang iyang amount sa future. So participation preferred stock may also have the right or additional features of participating or sharing with the common stock in additional dividends after the preferred stock. So the preferred stock has been credited when its regular dividend. So some preferred stock do not have this characteristic. As such participation, preferred stock may be further classified as participating and non-participating. So participating is a type of preferred stock that gives the holder the right to receive the dividends equal to the customarily specified rate or role that preferred dividends are paid to preferred stockholders, as well as an additional dividends based on some preferred predetermined condition. The non-participating is a preferred stock that specifically limits the amount of dividend paid to its holder. So ang kaning participating is mao ni siya ang maghatag og kanang preferred stock nga gihatag og sakto nga amount sa holders, kanang sakto ang iyang equal ra yang kanang na-receive na dividends ba sa kaning participating. Ang kaning non-participating is limit ra ang iya ang amount nga ihatag sa holder dito sa company. So ang last sa atong provisions of preferred stock is ang classes. So preferred stock may also be issued in classifying classes for different purposes. For instance, preferred share may be identified or classified as Class A or Class B, which could means Class A has certain features that Class B does not have. So the difference between Class A and Class B, shares of a company's stock usually same down to the number of voting rights assigned to the shareholders. Class A stockholders generally has more clout. So Class A shareholders usually has more voting rights than owners of the classes of stock. So the difference of relevant only to the shareholders who wants an active vote in the company. So ang kaning classes is magdepende ra jud ni sa classes sa stock. Pwede siya class A or class B. Ang kaning class is mas daghan gini siya og mga clout, mas daghan og voting rights kaysa sa kanang class B. Kaya ang class B is does not have features to write or kanang mas kuan ang class A kay daghan man siya og voting rights sa kaysa sa Class B.
Let's move to the advantages of the preferred stock issue. First, the claim of preferred stockholders on corporate earnings is usually limited to a specific amount or rate per share. Preferred stockholders have fixed claim on corporate earnings. This means they receive a set amount of dividends per share, which is usually higher than what common stockholders receive. It's like having a VIP pass to a concert. You get certain benefits that the general admission tickets holders don't have. Second, preferred stockholders are owners and they have no claim that can force the corporation into bankruptcy, proceeding for non-payment of dividends. On the other hand, when interest on a corporate debt is not paid, the creditors may start legal action to require payments. Preferred stockholders are like silent partners. They own a part of the company, but they can force the company into bankruptcy if it doesn't pay dividends. In contrast, if a company doesn't pay its debts, creditors can take legal action. It's like lending money to a friend. If they don't pay you back, you can force them to sell their belongings. But a bank could if if it was a loan. Third, preferred stock do not carry the burden of retirement or repayments since they are considered permanent financing. In contrast, long-term debts like bonds have a stipulated retirement or repayment periods. Preferred stocks are like a permanent loan to the company. Unlike bonds, which have a set repayment date, preferred stocks don't need to be repaid. It's like having a credit card with no due date. The issuance of the preferred stock will not jeopardize the existing controlling interests of the common stockholders. The voting rights of preferred stockholders are usually limited so that there is very little chance that they will gain control of the business. Issuing preferred stock doesn't threaten the control of common stockholders. Preferred stockholders usually have limited voting rights, so they can take over the company. It's like being a guest in someone's house. You can enjoy the amenities, but you can't make the rules. Fifth, the various provisions which may be incorporated in preferred stock issue make it a very flexible financing device. For instance, if investor require the issue should be made a participating preferred stock, this provision can be incorporated in the issue. Preferred stocks are flexible. They can have different features to make them more attractive to investors, like being able to participate in extra profits. It's like ordering costume or made dress. You can add whatever features you want to make it more appealing. Six, the cost of capital raised by preferred stock is less than that of common stock. For example, if the company issues a 10, 10 pesos par value preferred stock and receives 10 pesos for that stock after considering the expenses associated with the issuing process, the cost of issue at that time is 10%. Preferred stocks are cheaper than common stocks. The cost of issuing preferred stocks is usually lower than the cost of issuing common stocks. It's like buying wholesale. You get a better deal because you are buying in bulk. 7. Preferred stock increases the leverage of the common stockholders, since the rate of return paid to preferred stockholders is fixed. Any return earned above the fixed return helps to increase the return to the common stockholders. Preferred stock can increase the leverage of common stockholders, since preferred stockholders get a fixed return. Any extra profits to go the common stockholders. It's like having a fixed rent for a property. Any extra income you make from it goes straight in your pocket. To disadvantages of the preferred stock issue. First, dividends are fixed payments and it increases the financial risk of the firm, resulting to increases in the cost of all financing. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. There are there are a portion of the company's profits that are being returned to the shareholders. Now, when a company pays dividends, it reduces the amount of retained earnings, which are funds that could be used for reinvestment in the business. This could potentially increase the financial risk of the firm because it might need to seek additional financing for its operation or growth, which could increase the cost of financing. It's like spending your savings instead of investing them. You might have a less money to you might have a less money to use in the future when you need it. Second, dividends are not deductible as a tax expense unlike the interest paid on debt. Unlike interest on debts, dividends are not deductible. This means that the company can't reduce in taxable income by the amount of dividends it it pays out. On the other hand, when a company pays when a company pays interest on its debt, it can deduct that amount from its taxable income, reducing the amount of tax it has to pay. So, in a way, debt can be less costly for a company because of the tax benefits.
So I'm back and now I'm going to discuss the treasury stock. So treasury stock is issued by a corporation, lacks voting rights and dividends. Pero it can be acquired through purchase, also ensuring its full payment and reacquired without cancellation. So there are major use of treasury stock consist the following. First is the stock options. So ang stock options is mo-allow siya sa individual para mo buy og share sa common stock within a specific time period, transforming treasury stock into common stock with all rights and attributes. Second is the acquisition. So in acquisition, kay kanabitaw ang mga big company kay mo buy og small or little companies so that matawag siyang acquisition. So, the action may be facilitated gamit ang treasury stock. Third is the investment. So, sabotable naman ang investment, no? But i-discuss rin gihapon nako ang investment ug unsa na siya. So, investments, it involves the purchase of assets and also obtain involving an initial sacrifice followed by subsequent benefits, such as using treasury stocks for specific company needs. Fourth is the stock splits. So the stock split mag-involve siya by issuing new shares to stockholders without increasing the total capital. Also, aiming to reduce the average quoted price of shares and mag-enhance sa marketability. Fifth is the stock dividends. So when we are talking about dividends, we often refer to those that are paid in the company's own shares, including na ang treasury stock. Sixth is the convertible securities. So in the context of convertible securities, mo preferred siya securities nga naay potential nga mo convert into common stock para fulfill sa requirement, and we could use treasury stocks also. And next, and lastly, is the warrant. It is an option or a right that its owner may exercise nga mo buy og stock at a specified price and mo predetermine sa amount of time. There is also a conditions of warrants that may also be met using treasury stock.
Let's move to par value stock. Par value stock is like the price tag on piece of clothing in a store. It's like the minimum price at which a company can sell its shares as stated in its corporate charter. Just like you can't sell a price tag shirt for less than its market price, a company can sell its stock for less than its par value. Now, why is this par value important? Um, for two reason, uh, it is important if the company were to close down or liquidate. The par value is the amount that the preferred stockholders would get back. It's like a safety net, ensuring that they at least get back the minimum amount they invested. Second, the dividends that preferred stockholders receive are often calculated a percentage of the par value. So the higher the par value, the higher the dividends. It's like getting a percentage discount on that price tag shirt. The higher the price tag, the more you save. So, par value stock is like minimum price tag on companies' shares, which plays a key role in determining what preferred stockholders get in case of liquidation and how their dividends are calculated. It's crucial concept in understanding how stock markets work. Next is no par value stock. No par value stocks are those shares of stock without face or nominal value. When stocks have no par value, dividends are expressed in peso amounts rather than percentage. No par value stocks are like items in a store without a price tag. They don't have a set minimum price at which they can be sold. This gives the company more flexibility when it comes to selling its shares, as it's not restricted by a minimum price. Now, when it comes to dividends, there things are bit different. Instead of being a percentage of the par value, dividends for no par value stocks are given in specific amounts. It's like getting a fixed amount of cash back on your purchase, regardless of how much you spend. So, no par value stocks are like shares without a price tag, and their dividends are given as fixed amounts rather than percentage. This gives both the company and the shareholders more flexibility.
So the book value of a stock is its net asset value. So to make it more simple, it is calculated by subtracting total liabilities from total asset on the company's balance sheet. So it represents the theoretical value of a company's asset that would be left over for shareholders if all liabilities were paid off. So keep in mind that market value and book value can differ, as market value is influenced by factors such as investors' perception and future earning potentials. The other term for the book value of stock is net asset value, or NAV. Both terms are often used interchangeably to refer the value of a company's asset minus its liabilities on the balance sheet, providing a measure of the company's intrinsic worth. Next one is the market value stock. So the market value of a stock, often referred to as its market capitalization, and is the total value of a company's outstanding shares of stocks. It is calculated by multiplying the current stock price with the total number of outstanding shares. So this metric is used to assess the size and relative importance of the company in the market. So market value is a value placed at any one time on a stock traded in a stock exchange or over the counter. So, or even between parties in an encumbered transaction without jurors. Economic value stock. So these stocks are typically associated with companies that are considered undervalued based on their fundamentals, such as earnings, dividends, and book values. Investors often seek these stocks in the hope that market has underestimated their true worth, presenting an opportunity for capital appreciation. So analyzing financial indicators and considering a company's overall economic value relative to its stock price is crucial in identifying potential economic value in stocks.
This topic will help us know the bonds as distinguished from stocks, alternative ways of bond issuance, classes of bonds, and the reason for the use of bonds, and lastly, the indenture and the trustee. So first, let's talk about what is a corporate bond. So what is a corporate bond? It is a long-term financing, and also it is a company's long-term liabilities, since ang bonds is a debt instruments. So, utang siya, that's why company's liability siya. I will explain this further on the next slide, but first, let's talk about bonds. So, what is bond? Bond is a debt instrument of a firm or a government, and it is also written and made under the seal. So, this is an example of a bond. So the government and the company is a bond issuer, and they will issue bond to the investor. So if the investors purchase this bond, so the investors will give money or a capital to the government or the company. So that is how bond works. So the public or the investor will purchase the bond, and by purchasing the bond, they will give money or their capital to the bond issuer, which is the government or the corporate. And in return, the investors earn interest income, and upon maturity date, they can earn back the capital. And next is, let's talk about also bonds has a kind. So there are kinds of bonds, which is the government bonds and the corporate bonds. So what is a government bonds? A government bonds is a bond that is issued by the government to finance their activity. So this is an example of a government bond. So this is the government, and the government will issue a bond to the public or the investor, and if the public or the investor will purchase the bond, so they will give money to the government to finance their activities. And the next one is a corporate bond. So a corporate bond is a bond that is issued by private corporations to finance also long-term funding. So this is an example of corporate bonds. So the company or the corporate bonds, the company will issue a bond to the public or to the investor niya. If the investor will purchase, so tigaan sila. It's the same way as the government bonds, but kanilang siya kay ang company lang mo'y nag-issue og bond, dili ang mag-raise sila og funds for serving various business purposes. That is how bonds work. And next, let's talk about bonds as distinguished from stocks. So let's see how bonds differ from stocks. So what is stocks and what is a bond? A bond is a debt instrument. So utang, while ang stock is ownership instrument. So it is an asset. It is something you own. So since ang bonds kay debt instrument, so liability siya, which is ang stock kay asset siya, kay ownership instrument man siya. But they have specific maturity dates, and they have fixed interest payments and dividend earnings. Pero lang, ang bondholders have no voting or like influence, unlike ang stock. Naa sila mga votings like gikan sa stockholders and ingana. So how do we classify bonds? So bonds is classified by first types of security, by manner or participation and earnings, and by method of retirement or repayment, which I'm going to discuss about the types of security, and the rest of the two my other classmates will report. So bonds is classified by their types of security. This is I will going to discuss. So first, let's talk about debentures. So what is a debenture? It is a type of debt instrument. Gihapon siya pareha sa bonds nga ang company mo raise para sa kapital. Similar to bonds, but debentures is not secured by specific property. So there's no like agreement nga akong property, akong collateral para ani nga bond. In short, debenture is unsecured, unlike other bonds which are secured by specific assets. And next, next is mortgage bonds, or it is also known as mortgage-backed securities, or MBS. So what is a mortgage bonds? So it is backed by a pool of residential or commercial mortgage loans. So ang loans serve as collateral for the bondholders. So if the borrower dili makabayad sa mortgage payments, the bondholder nagpalit sa bond, ang bondholder have a claim on the underlying properties. So if ang debenture kay wala siya collateral, ang mortgage bonds kay secured siya og property or collateral, like naay. So ang mortgage bonds kay secured og specifically nga kanang mga named properties ingana. So it has a prior claim to assets specifically pledged as security. So ang mga assets atong naghimo sa bonds kay ma-pledge siya as security para if ever I cannot pay, if I am the borrower and I cannot pay, the mortgage bonds nga akong gi-issue kanang ang property or ang akong assets kay ma-collateral siya kanang as bayad or something. And lastly, there are two types of property pledge ang mortgage bonds. So katong naa siya i-pledge nga property para security as kanang collateral sa bond nga akong gi-issue. So there are two types. The real estate, which is consists of land properties mano. So it is also a pledge siya nga property para ma-collateral. The second one is chattels. It is a personal and movable property. So chattels is like for example cars, furnitures, and jewelries, like kanang makuan ra siya. So pwede sa na siya mahimong collateral. Lastly, we will talk about the classes of bonds by type of security. So atong ikuan ang bonds sa klase sa iyang security. So bonds by type of security. So first let's talk about the earnings and general unpledged assets. So katong unpledged assets mao to siyang debenture. So ang debentures kay under aning earnings and general unpledged assets kay wala man siya ma-pledge nga asset, dili man siya secure kay wala man siya collateral, there's no collateral property man. So ang debenture kay ma-under jud siya ani. And also ang next sad kay ang earnings iyang madawat plus pledge of specific property, which is ma-under diri katong mortgage bonds. Kay ang mortgage bonds kay naaman siya i-pledge nga kanang property, unlike sa debenture nga wala siya pwede ma-collateral. Ang under sa mortgage bonds kay katong like real estate o katong chattels nya nakakuan sa niya sa close-end issue ug sa open-end issue, which is and also the assumed bonds, guaranteed bonds, and joint.
So now I'm going to talk about the real estate mortgage. So according to the property of claims, there are two. So the first one is the senior liens. Senior liens refers to the security, interest, and investment that get repaid before other liens. Typically, senior liens are the first liens issued with a debt on an investment. So, for example, let's say a company takes out a loan and uses its property as collateral. So, the lender who issued the first lien on the property is considered as the senior lien holder. If the company defaults on the loan, the senior lien holder gets paid back before any other lien holders. So, the second one is the junior liens. So, a second mortgage, a junior lien, is a loan you take out using your house or as a collateral while you still having another loan secured by your house. So home equity loans and home equity lines of credit are common example of the second mortgage. So the main difference between the junior lien holders and senior lien holders is their position. In the line when it comes to for getting paid back if a borrower defaults on their loan and the property is foreclosed, the senior lien holder will be the first line to receive any proceeds from the sale of the property. So, according to the three type of issue, the first one is the closed-end issue. So, a closed-end fund is a type of mutual fund that issues a fixed number of shares through a single initial public offering to raise capital for its initial investments. Each shares can then be bought and sold on the stock exchange, but no new shares will be created and no new money will flow into the fund. So the second one is the open-end issue. So it is an open-end fund issue shares as long as buyers want them. So the third one is limited open-end issue. So an open-end mortgage is a type of mortgage that allows the borrower to increase the amount of the mortgage principal outstanding at a later time. Assumed bond, it is issued by one corporation and assumed by another. So assumed bond refers to bond that it is issued by a corporation. So it is guaranteed by a third party. That bond remains as a binding obligation for what it was originally given to secure. So however, this type of bond is common among railroads and it is also known as inverse bond and joint bond. So generally, assumed bond is issued by a subsidiary corporation whose parent corporation guarantees the principal and the interest payment. So guaranteed bond, it is a type of bond issued by individuals or corporation, providing additional protection to the bondholder. So a guaranteed bond, it is a debt security that offers to a secondary guarantee that interest and principal payments will be made by a third party and should the issuer default due to the reasons such as insolvency or bankruptcy. So joint bonds, it is several bonds and it is a type of bond that is guaranteed by at least two parties. Much like the CO signer of a loan, the second party guarantees payment if the issuer defaults, such as bonds are often used when a subsidiary of a parent company needs backing to get a loan. So issued by multiple companies where they jointly own the same property as a security, forming an debtor-bond relationship. So the chart tells about the manner of participation in earnings. So the chart, it shows the bonds are financial instruments that investors buy to earn interest, and essentially buying a bond means lending money to the issuer, which could be a company or government entity. The bond has a predetermined maturity date and specified interest rate. So the issuer commits to repaying the principal, which is the original loan amount of this maturity date. In addition, during the time up to the maturity, the issuer usually pays the investor's interest at pre-scheduled intervals, typically and semi-annually. So coupon bonds, it is a coupon or coupon payment. It is the annual interest rate paid on a bond. It is expressed as a percentage of the face value and paid from issue date until the maturity. So coupons are usually referred to in terms of the coupon rate, and the sum of coupons paid in year divided by the face value of the bond in the questions. Register bond, it is a debt instrument whose bondholder's information is kept on record with issuing party by archiving the owner's name, address, and other details information, and issuer ensure they making the bond's coupon payments to the correct person. And the income bond, it is a bond, it types of debt security in which only pays the value of the bond, and it promises to the paid to the investor with coupon payments and paid only if the issuing company has enough earnings to pay for the coupon payment. In the context of corporate bankruptcy, an adjustment bond is a type of income bond. Participating bond, it is a type of bond that besides being entitled to the interest at a fixed rate is a further entitled to a share and additional distributions on the specified basis with the common stock of the issuing company. And convertible bonds, it is a type of bonds that fixed income corporate debt security that yields interest payment, but can be converted into a predetermined number of common stock. Bonds with warrant, it is a type of corporate bond which is sold along with warrant and which entitles its holder to buy shares in the issuing corporation at a predetermined exercise price. And the warrant and the bond can be traded or exercised separately. And bond with junior security, last but not the least, it is a lower priority of claim on asset or income compared to the senior securities. And common shares are forms of junior securities whereas bonds are deemed senior securities, and after a senior securities are paid, and any leftover cash is divided among the junior security holders.
So, hi everyone, I am Ruela Misralta and my topic is all about bonds by methods of its retirement. So, first is ang serial bonds. So, ang serial bonds is repaid over a number of periods instead of one maturity date. So, this is unlikely sa traditional bonds. Kay, ang traditional bonds mo good, for example, ako nikuha kog 5 years nga bonds. So, makuha na nako ang complete principal payment ana, igabot sa maturity date, which is ang 5 years. So, ang serial bonds mong good kay for example, ang company, nikuha siya og 5 years nga serial bonds of 50,000. So, these bonds has a life of 5 years. So, in addition to interest, kay ang bond issuer mohatag siya og 10,000 every year with interest na siya hantod maabot na siya sa maturity date. So, mo na ang serial bonds. So, next is a sinking fund bond. So, ang sinking fund bonds kay muna siya ang mga gi-maintain sa companies for their bond issues, and this is also the money that they save para ibayad sa ilang mga debt, ilang mga utang or mga bonds. So, for example, ang company ni utang siya og ni-issue siya og 20 million nga bonds with maturity date of 20 years. So, ang company na mo issue na siya og sinking fund para igabot sa 20 years na sila mabayad. So, every year muhatag na sila og 1 million para igabot sa 20 years na sila 20 million. Mo na ilang ibayad sa ilang mga bonds. So, next is ang callable bonds. So, ang callable bonds kay it allows the company to pay off their debt early. So, it also benefit from favorable interest rate drop. So, for example, ang company ni issue og bonds with a face value of 18 rupees og 5.5% of coupon rate and also 3.5 interest rate, and it will mature at 10 years. So, kay callable bonds man siya, so na siya option nga iyang i-redeem or iyang ipadayon hantod sa maturity date. So, for example, ang interest rate ni decrease. So, ang company ana mo decide na sila nga ilang i-redeem og pwede ra sad ilang i-refinance or ilang i-renew with a low coupon rate. So, pero ang ani ang bondholder ani maka dawat gyapon sila og complete principal value. Pero in the future ilang madawat na lang ang coupon rate kay gamay. So, another example, ang interest kay maura gyapon or ni-increase. So, ang company ana, dili nila i-avail ang option nga i-redeem ang bonds. So, ilan na ipadayon hantod sa maturity date. So, mao na ang callable bonds kay high coupon rate siya, kay high risk man siya, dili siya pareha sa non-callable bonds kay low risk ra siya. So, next is ang convertible bonds. So, ang convertible bonds kay it can be converted into common shares with a fixed price. So, ang convertible bonds kay maka-decide siya nga iyang i-convert into shares or have its par value return igabot sa maturity date. So, kung ang bondholder maka-decide nga i-convert into shares, nasa tayo gitawag na conversion ratio. So, ang conversion ratio kay it specify how many shares of common stock it can be redeemed for. So, the higher the ratio, the more the bonds is worth. So, for example, kay 5:1. So, meaning ana kay 1 bond is converted into 5 shares. Another is 3:1. So, 1 bond is converted into 3 shares. So, mo na siyang convertible bonds. So, next is ang perpetual bond. So, this bond is non-redeemable bond suitable for public finance. So, ang mga financial institution ani o mga gobyerno kay mo issue sila og perpetual bonds kay para makatigom gani og pondo gikan sa mga fixed coupon or mga interest rates. So, kung ang bond maker mo decide siya nga yan tubuson niyang bonds, so still ang mga buyers ani makakuha gyapon sila og income because this bond is not regulated by any law that mandates the issuer to repay the principal. So next is the reason for the use of bond. So bond is used as a long-term financing for corporation. So it also contribute an element of stability to any diversified portfolio. So for me, kung nalakoy ka ng savings or ka ng extra money, mo issue jud kog bonds kay aside sa safe siya, maka ginansya gyapon siya bisag wa kay gibuhat kay kung mo issue gani kag bonds, igbalik sa kwarta nimo naman ay interest. So mo na ang ginansya. So mo na ang nakanindot sa bonds. So next is ang indenture. So ang indenture kay it is a formal written agreement between the corporation and the bondholder. So nanadiri ang details sa kanang unsay obligasyon sa corporation or unsay ang rights o unsa say rights sa bondholder and also the trustees duties. So next is the trustee. So it manage the asset in a trust and also ensuring the issuing corporation adheres to the indenture provision in the bond issue. So ang mga duties aning trustee kay it represent the bondholder in case of default and also siya say mobayad sa mga interest o principal o iya sad i-take care ang mga sinking funds sa trustor. So ang trustee kay mo ni siya ang tao nga gisaligan nga mukupot sa property or money sa trustor para maka-benefit ang third parties. Ug i-ensure sad sa trustee nga ang kwarta ug ang property sa trustor mabahin gani og tarong sa beneficiary fairly and efficiently.